Hello everyone, welcome to the 30th module of GKToday's Banking Awareness course. Today's topic is lending operations. I'm Ritrisha from GKToday and let us begin. What do we call the money that is lent for one day in the call money market? Correct answer is call money. So call money refers to borrowing or lending of funds for one day. Now, money market instruments are those instruments which have a maturity period of less than 1 year, and call money is one such instrument. Why do banks borrow money in the call money market? Correct answer is all of the above. So there are a couple of reasons why banks borrow money from the call money market. They are to cover the gaps of temporary mismatches in funds, to meet statutory reserve requirements such as cash reserve ratio and statutory liquidity ratio as set by the central bank, also to meet sudden demand for funds arising out of large outflows. What do we call the money that is lent for more than one day but less than 15 days in the call money market? Correct answer is notice money. As we just learned, call money is something that is borrowed less than one day. Similarly, notice money is anything that is borrowed between 2 to 14 days. There's also another one which is known as term money, which refers to borrowing more than 14 days, that is 15 days or more. What is the maturity period of money market instruments? Correct answer is less than 1 year. As we learned in the beginning, money market instruments are those which have a period less than 1 year. That is, it includes stuff like call money, which is an overnight call, and then there is term money, which is between banks and institutions, and repo transactions as well, which is in fact one of the most important part of the money market. What do we call the facility given to a current account holder of withdrawal of more amount than his deposit? Correct answer is overdraft. So this is when a credit agreement made with a bank will allow the account holder to withdraw money which they don't have in their account, that is more than the approved limit of their account. What do we call an unconditional order to pay a certain amount on an agreed date? Correct answer is bill of exchange. The bill of exchange contains an unconditional order to pay a certain amount on an agreed date, while the promissory note contains an unconditional promise to put a certain sum of money on a certain date. What is down payment? This is something we are all probably aware of. Correct answer is difference between total purchase value and the loan amount. So when you take loan for an item, suppose you're taking loan to buy an apartment. So there's a certain percentage of the actual purchase value of the apartment that you have to pay on buying it, and the rest of it is what you ask for a loan. So this is an agreement that the borrower is responsible for providing funds, and the down payment is the first fund they pay. What do we call the process of paying off an existing loan and establishing a new one? Correct answer is refinancing. So the answer is in the term. So when you are financed, it means you have been given a loan. So when you rearrange that loan, it's refinancing. Which of this is used as a promise from a bank to make a payment assuming certain conditions are met? Correct answer is letter of credit. This is a letter from a bank that guarantees that a buyer's payment to a seller will be received on time and for the correct amount. What do we call the guarantee given by the bank for a payment when the buyer is not able to pay the required amount of money to the seller? This is known as bank guarantee. In a bank guarantee, the payment is done only when the buyer is not able to pay the required amount, and then that's when the bank steps in. That's all for this video. If you like this, don't forget to like it and share it, and keep subscribing to GK Today. Until next time, goodbye and good luck.